Thanks for joining us today on The Close. I'm Marella Fernandez. Markets close in a half hour's time. Let's get to the stories we're following out of the BNN Bloomberg newsroom. The U.S. President Donald Trump has gone to Michigan to promote his efforts to boost U.S. manufacturing. He toured a Ford plant today with the automaker CEO. And during that tour, Trump dismissed the relevance of the U.S.-Mexico-Canada trade agreement and emphasized the need for auto manufacturing in the U.S.
I don't even think about USMCA. I mean, I want to see Canada and Mexico do well, but the problem is we don't need their product. We don't need cars made in Canada. We don't need cars made in Mexico. We want to make them here. And that's what's happening. Everybody's moving here. From Canada, they're coming here. From Mexico, from Japan, from Germany, from all over the world, they're coming here. They're opening up their plants.
The Prime Minister, Mark Carney, met today with coastal First Nations in BC to discuss major projects. A First Nations Alliance group has said there's no support among the group for a pipeline or the suspension of the oil tanker moratorium. It comes ahead of Carney's departure for China, where he aims to boost engagement on trade, energy, agriculture, and international security. And Bloomberg reporting China will propose easing some restrictions on canola products in exchange for relaxed tariffs on Chinese EVs. The report says Chinese authorities plan to discuss reducing levies on industrial products from China. Canadian officials say they hope to ease trade friction, but played down a prospect of a quick deal on EV tariffs. Shares today of JP Morgan falling. The American bank met estimates for fourth quarter revenue. However, there was an unexpected drop in investment banking fees. The biggest U.S. bank generated over $2 billion from the business in the last 3 months of 2025, but that's down 5% from the year before. Here's where we are on the markets right now. The TSX is actually down 6 points. That has just changed. It's at 32,868. Let's go south of the border. The S&P 500, a 35-point drop today, about half of 1%. The Dow Jones, a 500-point drop, down a full percent so far in the day. And the Nasdaq has a 104-point drop right now, down about 0.4 of 1%. So not a lot of movement, as you saw on the TSX today, but we have already seen several record closes this year. Let's start there with Carl Berger, Senior Wealth Consultant and Investment Counselor at Seidel Asset Management. Thanks for joining us today.
Nice to be here, Marilla.
Is the TSX mostly benefiting at the start of the year from the run-up that continues in gold?
Yeah, it's a pretty similar story to how we ended last year and really the whole last quarter of last year. Gold prices remain strong. There's certainly interest in the sector, but there's actually a lot of decent things going on in Canada right now. There's a fair bit of confidence amongst CEOs across Canada in terms of where the Canadian economy is going. I think a lot of people are surprised that we're holding up quite as well as we are. So there's a bit of broad support, although the euphoria in the TSX is certainly concentrated in the materials sector.
Okay, how much of the movement in gold do you attribute to what's going on in the U.S., meaning the uncertainty of a Trump administration?
Oh, wow. I mean, I think most of any theme like that relates to the U.S. at this point, and whether it's precisely what the Trump administration is doing or the level of U.S. indebtedness, the propensity and the requirement for the U.S. to borrow consistently over the next number of months and years. I think a lot of it comes back to the policies and to the way things are playing out. I don't know that gold is entirely a fear or chaos story. I think there has been a demand from central banks in particular, so there is a real aspect to that part of the story. But it is multifaceted at this point, and it's a fascinating topic for investors because it really comes down to risk tolerance and risk appetite. it would be really easy to make a case for gold going to $5,000 an ounce, $6,000 an ounce, $8,000 an ounce, pick a number. It would also be fairly easy to make a case for it going back to 3,000, and that really being simply a retracement or a correction in the very, very strong move that we've seen over the last couple of years. It's difficult to invest in that sort of dynamic when there isn't a cash flow associated with it. And yet gold has been a massive story, obviously, and is going to continue to be.
Okay, can I get your take on Canadian energy as well? With the recent changes in Venezuela, what are your thoughts about the Canadian energy space moving forward? Because people were very bullish on it last year with the build out of the AI data centers. And I'm looking at the price of oil and what's going on with Venezuelan oil and wondering what you see ahead.
Yeah, I think I'd say we're generally a bit cautious on the sector overall, mostly from a supply standpoint. So what happens if all kinds of Venezuelan oil comes on the market? And it certainly isn't coming on anytime soon, or at least not in any kind of quantity. We think about the potential for a resolution to the conflict in the Ukraine at this stage, and what happens if sanctions against Russia are unwound. So the supply side of the oil dynamic still seems to be not necessarily supportive of the price of oil overall. And the Canadian industry is fairly well situated to take advantage of it. Canadian firms are returning have an awful lot of cash that they're in the process of returning to shareholders. So it's not a sector that we're heavily invested in at Sidel, primarily because we like to be able to focus free cash flow generation and model out what we expect companies that we own to produce over the next 5 or 10 years. And that's really, really difficult to do with any kind of certainty when you don't know whether oil is going to be $60 a barrel or $80 a barrel or $50 a barrel. But we do have some exposure in the Canadian oil patch, and we're not uncomfortable with it.
All right. You've been watching or keeping a watch of indicators for a bear market. The first one I know you pay attention to is inflation. We have new data out in the U.S. What does it tell you?
So inflation is still uncomfortably sticky, I would say, and at a level that is higher than the U.S. is comfortable with, and that investors should be comfortable with, certainly higher than the Federal Reserve is comfortable with. On the good news side of things, it hasn't gone significantly higher, and I think a lot of people worried about that from a tariff standpoint. But in terms of where we're at, in terms of that as an indicator, I'd say inflation is not a huge red flag for us at this point. It's not suggesting that a bear market is imminent or strongly headed in that direction.
Tech valuations, of course, or valuations in tech, the tech sector became an issue more for North American investors at the end of last year. People started worrying about all the spend on the AI data centers and what it would amount to in the end. Are valuations still a concern for you this year?
Valuations are always a concern, but tech valuations are fascinating because of exactly the dynamic you mentioned. There's all of this spending on AI. Sooner or later, it's going to have to create a tangible return. And with the volume of spending or the quantum of spending, that return is going to have to be absolutely significant. And we don't necessarily see where that new revenue is going to come from at this point. And it still sounds like there is going to be incredible spending on the concept in 2026, 2027, and beyond. So it seems like it's still supportive of things, of the economy at this point, of corporate profit growth. Certainly something to be cautious of, but it looks like 2026 is going to start the same way 2025 ended in that regard.
Okay, so Carl, when you take a step back and you look at the indicators for a bear market overall, what are you seeing?
Overall, there's nothing that screams to us that a bear market is imminent. Inflation is, as I mentioned, under control, not going higher, not probably as low as we'd like. Central banks are not reacting in a hostile manner. They're not raising rates really anywhere. Term rates are going a little bit higher because of concern over inflation in the future, but that's not a huge concern. There isn't incredible investor sentiment. There's not a rational exuberance, to go back to Greenspan's quotes or terms from the 1990s. Valuations, as we touched on in the tech sector, are a little bit robust. In other parts of the economy, really aren't that challenging. So overall, I mean, there's nothing to say that we won't go into a bear market at some stage. There's nothing to say that certainly nobody's waving the all clear flag, suggesting that it's okay to take risk at this point. But I would say that at best or at worst, the indicators are neutral at this stage, and that there's nothing that imminently suggests to us that a bear market is coming.
Got it. Carl Berger, thanks for joining us today. Appreciate your time.
You're welcome.
Coming up next, American markets in the red today. TSX just sliding into the red late this afternoon, despite the inflation numbers coming out of the U.S. that showed inflation really didn't change. It was 2.7%. We're back in a moment with details. The Prime Minister is headed to China as Canada looks to expand its pool of international trading partners. CTV's Annie Bergeron-Oliver has more on what the PM is hoping to achieve during the visit, which will be the first, of course, by a Canadian Prime Minister since 2017.
Prime Minister Mark Carney is getting set to depart for a 9-day trip to China, Qatar, and Davos. In all three countries, the Prime Minister will be meeting with foreign leaders, business leaders, and CEO, with the focus of expanding bilateral relations, increasing trade, and increasing foreign investment in Canada. Now, the part of this trip that's getting the most focus is his 3 nights in China. This is Prime Minister Mark Carney's first trip to China as Prime Minister, and also the first trip by a Canadian Prime Minister since former Prime Minister Justin Trudeau was there in 2017 to try to establish a free trade agreement. That did not happen, and very shortly after, the CEO of Huawei, Meng Wanzhou, was detained in Canada at the request of the United States. That led to China retaliating by detaining 2 Canadians, Michael Kovrig and Michael Spavar, who were eventually released. Relations with China have been strained and extremely tense since then, back in 2018. Now, the Prime Minister's office says that Carney and Xi have both agreed it's time to revive that relationship, to try to improve bilateral relations. And that is what this visit to China is all about. It's about trying to bring stability back to this relationship, to try to bring it back to where it was before 2018. Now, speaking on background, officials do say they expect to see some progress on tariffs, but they don't expect to see tariffs removed entirely. Right now, China has a 100% tariff on canola oil and strong tariffs on other agricultural products that are really threatening the industry. So again, officials are saying they do expect to see some progress on those tariffs, but they don't expect to see them removed completely. Of course, anything can change. Now, while in China, the Prime Minister will meet with Xi Jinping. He'll meet with the Premier. He will also meet with business leaders and CEOs. Again, the main focus here is trade, trying to get rid of these tariffs, trying to improve the bilateral relationship. However, there will also be other topics brought up. For example, they say agriculture, energy, very important issues. We expect to see some type of conversation around autos and EVs. This is what experts say they expect to bring up as part of that tariff discussion, and as well just trade in general. Now, the Prime Minister's office and officials speaking on background have said that they do expect the Prime Minister to make it very clear to the Chinese government and to Xi Jinping that Canada wants to increase business and trade with China. However, there are certain guardrails that they want to put up in place. For example, they don't want to do business in artificial intelligence or critical minerals. Now, again, this is a 9-day trip. The first stop will be China, then he'll go to Qatar, and then to Davos in Switzerland for the World Economic Forum. Annie Bergeron-Oliver, CTV News, Ottawa.
There has been a groundswell of support for the chair of the U.S. Federal Reserve after it was revealed he is the target of a Department of Justice investigation. Prosecutors are looking at testimony he gave about a renovation of the bank's headquarters and a reminder about what Jerome Powell had to say about it.
The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president.
All right, joining us for more on this is Charles Myers, chairman and founder of Signum Global. Thanks for joining us today.
Thanks for having me.
Are you surprised by the public statement made by Powell? Usually he likes to stay out of the spotlight. And if you are surprised, what does it tell you that he felt compelled to make an announcement like that?
Yeah, it is. It's an extraordinary move or, statement from the Fed chair to put a video out to rebut, kind of not only the allegations, but the process. And so I think, it just highlights how much pressure the Fed is under from the administration, from the president, and how willing the chair certainly, and I would argue most of the FOMC, is to fight back or to stand their ground and remain independent. So I think that every investor in the world sees through this and understands that it's politically motivated. And I think that even the administration's backed off a little bit in the last 24 hours. So, and lastly, I would just say that, if anything, it probably strengthens Chair Powell's resolve to stay on the FOMC after his chair term ends in May. I think he stays on as a voting member of the FOMC now till 2028.
Okay, and if he does do that, how do things change as far as the math goes behind the scenes?
Well, I think, in the end, if you look at the number of potential appointees that the president can make between now and the end of his term, it'll still be a minority of voters on the FOMC. So I think that with Chair Powell staying, it's even, a slightly, even smaller minority that the president has. But de facto, just in terms of monetary policy going forward, to say that from May onward, when the new Fed chair is installed, it will be an FOMC that by composition is a little more dovish. I think still very independent, which is important for the markets and the safe haven status of the United States, but probably on balance, a little more dovish.
Okay, let's talk about the criminal case for a moment. I'm wondering if you think it'll get very far. You've seen and noted a retreat already in some of the rhetoric. Donald Trump, for example, isn't commenting on it. And we've seen some of these other, quote unquote, revenge kinds of cases stall, like the one against James Comey.
Yeah, this one I think absolutely stalls. I think it'll be a very long investigation. Ultimately, of all the things to try to pin on the Fed chair, cost overruns for a building renovation is not a particularly serious one. So I think it'll be a long-running investigation that leads nowhere. All
right. What is the risk of political directives in monetary policy?
Well, I think, the president, since he came back into office a year ago, has consistently put pressure on the Fed very publicly to try to, lower interest rates faster. I'm not sure that the pressure campaign is working. I think the Fed takes every member of the FOMC, every voting member takes their role very seriously as the independent monetary authority of the United States. And I think it just keeps their head down, including the chair, and does their job. I think they're data dependent, they're independent, and they will continue to follow the data.
I do want to ask you about Venezuela as well, because you see investment opportunity there and have seen that for some time, though, as you know, there are many who say there are too many challenges, particularly in the oil industry, around infrastructure and laws to try and make it work. What are your thoughts on investing in Venezuela and what that looks like?
So we're very excited. I'm very excited about the outlook for Venezuela, particularly for foreign investment. Now that the United States has removed Maduro, the United States now has a huge vested interest in the economic success of Venezuela. Central to that success is foreign investment. And I think oil and gas gets, rightly so, all the attention because that's the priority. But there are huge investment opportunities in construction, in infrastructure, in mining, steel, banks, insurance, even in the defaulted sovereign bonds, PDVSA bonds. So we're taking investors down to Caracas late March, about 20 to 25 investors, to do some due diligence and look at reconstruction opportunities. Lastly, this is a country that is emerging from 25 years of dictatorship and economic mismanagement. It's going to take some time, but I think it's a good time to get down there early and kick the tires and do some due diligence.
What are the one or two things that have to happen before you can really reinvest into Venezuela?
So I think, a couple of the U.S. CEOs have been pretty articulate on this. First, we need to make sure that the current government, because there's only been a change of leadership at the top, as you know, but that the current government is stable and is going to last. Secondly, that this government can maintain domestic security so that companies feel comfortable going down, visiting, and looking at investment opportunities. Third, changes to some of the legal structures, especially around foreign investment, change to the hydrocarbon law, for example, for oil and gas companies. And lastly, we need sanctions to be lifted, which the Trump administration is working on as we speak.
All right. Charles Myers, thanks for joining us. Appreciate you joining us on The Close today. Thank you.
Thank you.
Coming up next, U.S. markets were in the red today, despite U.S. consumer prices increasing less than expected for the month of December. We'll dig into the numbers when we come back. progress in the fight to throttle back inflation in the U.S. appeared to stall at the end of the year. But our next guest says the key positive in the report is flat core goods prices. Let's go to Olu Sonola, U.S. Head of Economic Research at Fitch Ratings. Thanks for joining us today.
Thanks for having me.
Are we still seeing tariffs being passed through in the U.S. here?
It's hard to see at this point in time. Based on the data we got today, the month-on-month reading was basically zero. So that's evidence that you're not seeing that pass-through. Companies have used various strategies to mitigate the pass-through. The key question is, for how much longer? Are they going to be able to continue the mitigation strategies through 2026? Or are we getting to a point where they would have to pass through a lot more of those tariff revenue increases, a lot more of the cost from tariffs?
Electricity prices up almost 7% from the December before to last December. What led to that?
It's always difficult to really nail that down, but I will not be surprised if that has a lot to do with wages. My sense is we've seen labor supply, particularly when you're talking about hourly labor. So, particularly when you're thinking grocery stores and grocery chains, they use a lot of that type of labor. And there's been wage inflation generally in that area of the economy. So I'm not surprised if that's been passed through in the form of higher food prices.
All right. Where does all of this lead you on a rate cut for 2026?
We think 2026, we're looking at 2 rate cuts in 2026. Definitely, we don't think that they go in January. It looks like March is a go. We also think probably another one before the end of the first half of the year. So we're looking at 2. Inflation is inflation generally may mean that they will be a lot more cautious. But if we see the trend that we saw today, if the data that we saw today continues to be the trend, then they probably will go in March.
Okay, and that's because you see inflation moving higher.
Yeah, we do see inflation moving higher. We think there will still be some pass-through in 2026. And we're looking at inflation right around 3%. Some people think it goes lower. We do think it moves higher.
Olu Sonola, I'm going to leave it there, so I'm out of time. Thank you for sharing some of your time today.
Thank you. Thank you for having me.
All right, a quick look at the markets as we head to our break. Coming up next, the closing bells on Bay Street and Wall Street. We're back in a moment. Here are the closing bells for the end of the trading day. At the NASDAQ, the PWHL New York Sirens ringing the bell. And in New York, PAG Bank ringing the closing bell. You're watching the close on BNN Bloomberg. I'm Marella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX ending the day just in the red by 4 points after a record close this week. S&P 500 also had a record close, but now 13 points down on the day. The NASDAQ dropping 24 points, so not a lot of movement in the North American markets. But let's get to the movers in Toronto. We're going to start with Cenovus, which moved up close to 7% today. That's a gain of $1.47 a share to $22.68. Enerflex also moving up today. It's a gainer on the TSX. It gained around 5%, closer to 7%. I lied, that's $1.47. I guess we missed Cenovus, and we're keeping here with Enerflex at $22.68. Let's go to International Petroleum, which moved up over 5%, $1.32 gain to $26.02. And then in the red, G Mining Ventures moved down today. It lost 7%, or $2.95 a share, but it is up close to 200% over the last year. Kinaxis is the other stock we are looking at today. It dropped 3.7%. That's a $6.66 loss, taking the stock to $174 flat. Arrow Copper also moving today. It dropped 3.7%, almost 3.8, a loss of $1.62 a share. Let's go back to Cenovus, which we missed off the top. It gained close to 6%. That's $1.37 a share, taking it up $24.46. All right, let's get to the movers south of the border. Bloomberg's Michael Regan joins us now. Michael, J.P. Morgan shares off. I saw last 4% after that earnings report. Where did it come up short?
Yeah, Marilla, J.P. Morgan really kicking off the earnings season here with a bit of a thud. In general, from the big picture, the earnings report was pretty solid, but there was unexpected weakness in their investment banking fees. Those were down about 5% compared to the last guidance the bank gave in December for an increase in the low single digits range. So not only that, Marilla, but there is still a lot of concern on Wall Street about President Trump's plans, or desire at least, to cap credit card interest rates at 10%. So weakness really across the board in banks and other companies related to credit card lending. Now, J.P. Morgan CFO Jeremy Barnum really warned against this proposal, saying it would significantly change the business and would harm not only the biggest U.S. bank, J.P. Morgan, and its customers, but really the economy as a whole. And he warned that when it comes to pushing back against this proposal, Morella, he said everything's on the table. So J.P. Morgan gearing up for a fight over this cap on credit card fees.
Yeah, it definitely sounds like they're digging in on that. Okay, Moderna up something like 14%. On what news?
Yeah, really strong news. Not really any, one single piece of news, but the news flow has been pretty positive for the stock over the last 2 days. For one thing, the New York Times has reported that 6 leading medical organizations plan to ask the courts to throw out revisions to the childhood vaccination schedule that were announced by the Health Secretary RFK Jr. Last week. And also, Moderna's CEO spoke at a J.P. Morgan health conference yesterday, and described what he calls an exciting pipeline full of catalysts for this year. That includes a new flu vaccine that they're seeking regulatory approval for, as well as a combo flu and COVID vaccine. They also talked about plans to invest in their oncology and rare disease assets should the cash flow remain solid from their respiratory vaccine products. So really strong day for Moderna, and a decent day for other vaccine makers as well.
Okay, let's get to Intel, now partly owned, of course, by Washington, moving up today. What triggered that?
Yeah, up about more than 7%, up really as much as 9.5% during the day. This is after analysts at KeyBank Capital Markets upgraded not only Intel, but also AMD to overweight, talking about how both companies have largely sold out of their server CPUs for 2026. Also pointing to a strong start for Intel's new chips that are made with 18A technology, which Intel says offers advantages that other chip makers don't have, this new technology. So really strong day for Intel, rising to an almost 2-year high today.
All right, we will leave it there. Michael, appreciate you joining us. Thanks for your time.
Thank you.
All right, when we come back, a deeper look at what moved the markets in the U.S., which ended up in the red. We're back in a moment. The S&P retreated from a record high after investors sold J.P. Morgan following a miss on fourth quarter investment banking fees. Let's go to Doug Pita. He's Chief U.S. Investment Strategist at BCA Research. Thanks for joining us today.
Thanks for having me.
Overreaction, you think, by investors to that miss by J.P. Morgan?
Yeah, perhaps a little bit, especially because I think the credit card interest rate cap is subject to revision. That 10% cap is hardly a final number. JP Morgan and the other banks will deploy all of the lobbying firepower at their disposal to try to push back on that limit.
I'm surprised that there seems to be so much concern about that one-off comment from the president, because, as you mentioned, it is something that will be hard to put through.
Certainly it will, but this very much fits in. The comment from the president very much fits in with the administration's desire to get on the right side of the affordability question ahead of the midterm elections in November. So I would expect that we're going to see more and more out of the White House about, at the very least, trying to appear as if the administration is doing something to try to bring down expenses for the rank and file households in the U.S.
What would you see as a fallout from something like that if it does come about, a cut in interest rates for 1 year?
Well, I'll tell you, the fallout that I think importantly would occur for markets is that if you were to have the White House or even any branch of government in the United States be able to cram down rules on businesses that previously were able to, within the parameters of reasonable regulation, make the decisions that were the best decisions for their shareholders, I think you would see the multiple that investors pay for U.S. stocks would fall. And I think you would see interest rates rise because Treasury buyers would be adding a risk premium that hadn't been there before to account for capricious decisions and heavy-handed, imposures on the free market that hadn't been there before. So all in all, I think it would be negative for, again, stock prices. It would cause interest rates to be higher than they would otherwise be. And I think it would also weigh on the value of the U.S. dollar, as investors around the world would see the U.S. as a less attractive destination for their capital.
You've been looking as well at U.S. consumer spending, and despite slower job growth, Americans are still spending. Why do you think that is?
Part of it is that they cut their savings rate by a full percentage point from the first quarter, from 5.2% to 4.2% in the third quarter. So if you spend more of what you earn, if you set less aside in your paycheck every couple of weeks, that will allow you to spend more. Unfortunately, that one is probably not all that sustainable, because now the savings rate at 4.2% is very low relative to history. And that suggests that households don't have much more scope to reduce their savings. On the other hand, households have not borrowed very much in this cycle, and therefore they do have dry powder in terms of borrowing capability, and that is something that would allow them to maintain consumption at a fairly robust growth rate, even if their income was growing at a slower rate, if their income wasn't growing enough to support the consumption. But I think those are, kind of quick fixes. And the route to more durable strength in consumption is for household incomes to pick up, for compensation to pick up. And the only way that happens is if we do see hiring begin to pick up. It has slowed to an absolutely anemic pace.
Do you think there is more enthusiasm from consumers because the interest rates have started to go down? That puts a little more money in their pocket instead of going to the mortgage, perhaps. And also, I'm sure there's a lot of expectation around tax cuts that are coming for them this year.
The tax cuts should be helpful. And all in all, lower interest rates ought to be as well. I'm not sure that it was interest rates that have dampened consumer sentiment and have dampened hiring. So our view is that at the margin, very slightly at the margin, lower interest rates will help. And we do expect that the Fed is going to cut rates more than markets currently expect. Right now, they're pricing in 50 basis points of cuts in 2026. Because we think the weakness in the labor market is going to prove to be more durable than it might appear at first blush, we think that the Fed is going to have to be cutting more in 2026 than expected. By itself, that would be good, but that's a little bit of a case of be careful what you wish for, because if the Fed is cutting rates because the economy is weaker than had been perceived, that doesn't necessarily help stocks. It doesn't necessarily help consumption, because part and parcel of that is that it becomes more difficult to find a job. So if the Fed cuts more than expected because the labor market is weak, we think that the labor market weakness will outweigh the boost from lower interest rates.
Doug Peta, got to leave it there, sir. Thank you very much for sharing some of your time for the program.
Thank you.
When we come back, we'll continue our coverage of the Prime Minister's visit to China. He's en route. We'll take a look at the issues when we come back. Prime Minister is headed to China for the first visit by a Canadian leader in over 8 years. As U.S. protectionism intensifies, Carney's looking to foster trade relief and investment opportunities for Canada. For more, we spoke to Colin Robertson, former Canadian diplomat, now with the Canadian Global Affairs Institute.
He's hoping to stabilize the relationship with China that has been essentially in the doldrums since 2017, particularly since 2018 and the hostage taking of the two Michaels.
Now, on the Bloomberg report, there's hints that we could see something possibly when it comes to canola. Is that realistic to expect any kind of deals from this first visit?
I think more likely to see a process set in place that will eventually lead to movement on the tariffs on both sides. The EV tariffs that Canada's applied in tandem with the United States in couple of years ago now, when Chrysler Freeland was our finance minister, and the Chinese response with the tariffs, not just on canola, Roger, but also on seafood and on seafood and pork. So and these are important. Chinese were quite astute in putting these tariffs on. They chose to put them on products that came from other parts of Canada, so they've also played into our federal relations splits.
And are the tariffs on EVs, can that be on the table, do you think? I'm just trying to balance with our negotiations with the U.S. So you think
I think that's a critical piece. And yes, I do. I think they can be. But I think, as even Premier Ford has said, we would look at this if the Chinese were going to do manufacturing in Canada, creating, as he put it, uniform jobs with technology transfers. And I think that would be our asking point. If you want to come in here, just the same way the Koreans and the Japanese came in the 90s and on, we did it in such a way that they situated in Canada and created jobs, just going back to the original Auto Pact, which ensured jobs in Canada. But if we're at risk of losing those jobs because of Mr. Trump's actions, then we do have to look at other alternatives. So I think you'll see discussions on what the Chinese really have in mind, and that will play off on the tariffs on the Chinese applied to Canada.
Would that be something they'd be open to, China that is, to start up here, a factory?
Yes, certainly my discussions with the Chinese embassy is that they're right now in a bit of a charm offensive towards Canada. They'd like to drive a bit of a wedge between the United States and what it has been its closest trading partner, or biggest trading partner and closest ally. And so I think, yes, I think that would be something the Chinese would consider, but they will expect us then to show a quid pro quo. When you deal with the Chinese, you deal on the basis of reciprocity. And we've not always taken advantage of that in the past. I think sometimes we've been a bit naive, but I think we go into this, as they say, eyes wide open, but also quite prepared to discuss the full range of things and hoping to getting, as I say, stabilize the relationship and make progress on trade and investment, people-to-people ties, and discuss what the red lines are in other areas like Chinese interference in Canada and disinformation campaigns.
Now, do you think China would be willing to play fair with some of those things?
I think that China, just like other countries like India, they will push our boundaries as far as they can unless we act. And I think we have not been good at enforcing our own red lines in the past, but I think that is changing. I think Canadian public opinion wants to see enforcement, and I think Canadian parliamentarians. So I think that we make very clear to the Chinese that you do this, we P&G, we throw you back, diplomats back to China, and we'll prosecute those who break our laws. But we have not done that, and that's on us. But I think going forward, that's not going to apply anymore. And you're seeing this not just we will see this not just Canada, but you're seeing this in Britain. The United States certainly does it well, and Australia is now picking up, as does New Zealand.
And so is it really just trying to see how much they can get before we finally stand up?
Absolutely, but this is how China does business around the world, and indeed how most countries try and do business. You push as far as you can and see what the guide wires are. And as I say, I think that's a message the Prime Minister will have to, in the frank discussions that will take place. They'll also talk. He'll also raise human rights, but I think do it quite differently than either Prime Minister Harper or Prime Minister Trudeau did. He'll do it more like Prime Minister Mulroney and Prime Minister Chrétien, who would go in and focus on particular human rights cases where there was a close Canadian connection, and then the Chinese will take you seriously. Otherwise, they think you're just preaching to them or sermonizing.
Now, and of course, the other side of all this, great if we land some deals, but what are the dangers when it comes to our negotiations with the U.S. in regards to CUSMA? And I mean, Trump has said maybe we'll get rid of CUSMA, but the U.S. is still our most vital trading partner.
Absolutely. No, you're absolutely, that's it, Roger, is that all this takes place against the backdrop of our ongoing negotiations with the United States. That is the most important relationship. We would like to maintain the preferential relationship we have with the U.S. for our trade and investment through a renewed CUSMA. But as you know, that's all in play. And at the same time, we've got to think about contingencies should that not work out, which is why we're talking to China and why the Prime Minister is going on to Qatar and going on to Davos and leading a Team Canada mission later this year to Asia and ASEAN, and we're trying to reopen a relationship with India.
Do you think China would the U.S. would, Trump especially, essentially, I mean, it's all Trump, would respect if we came at him with possible deals lined up with China, India, and would he look at that with respect, or would he get mad at us and just cut us off again?
Roger, that's the million-dollar question. So I think that, we move with circumspection, and I think at the same time, there's no surprises either in dealing with the Chinese or with the Americans. We keep them well informed of what we're doing and test. So we don't do this publicly. Our new ambassador, Mark Wiseman, will be very busy when he gets to Washington, and we'll be doing the same thing in China through Jennifer May, our ambassador there. That's how Canada traditionally did diplomacy, and that's why we were successful in the past, because we approach things on no surprises and keeping friends and allies and adversaries informed.
Colin Robertson, former Canadian diplomat and now a fellow at the Canadian Global Affairs Institute. The Prime Minister's trip to discuss agriculture, among other things, comes at a time when farmers here at home are struggling to turn a profit. Tariffs are driving down market prices. But as CTV's Alison Bamford reports, this visit is sparking some hope.
This time of year, Ryan Scragg should be hauling grain. Instead, he's pushing snow and wondering what he's going to plant in the spring.
The problem is right now is that nothing pencils out to a profit.
Canola and peas usually make up about 70% of what Scragg grows, but both crops face punishing tariffs from China that have pulverized market prices. Right now, all of Scragg's bins are full, but normally for this time of year, he said at least 20% of his grain would already be sold.
I'm waiting as long as I can. At some point, there's just no more option of waiting.
Many face the same challenges, now clinging to hope that upcoming talks between Prime Minister Mark Carney and China's president will progress trade negotiations.
What we're hoping to see now is that we can translate some of that engagement into action on these issues.
Carney's visit to China, slated for next week, is planting optimism ahead of spring seeding. But farmers still mindful that these tariffs were put in place last March and removing them takes time.
I don't see them inking a trade deal or something that immediately fixes it. But I think doing anything is better than doing nothing.
For now, farmers like Scragg will weather the storm. He plans to cut back on canola and nearly drop peas altogether this spring, seeding a little bit of everything, hoping he can grow a profit. Alison Bamford, CTV News, near Prince Albert.
Coming up, more on JP Morgan's fourth quarter. Back in a moment. Here are the stories we are following in the newsroom. Shares of Maple Leaf Foods up today. after the packaged protein company boosted revenue in its 2026 guidance and raised dividends. The Ontario-based company is targeting revenue growth in 2026, supported by sustainable meats business, core brands, and more U.S. distribution. Maple Leaf's also planning to increase its quarterly payout to shareholders by 10%. McDonald's Canada freezing the price of some of its items for 1 year. So a small cup of coffee will remain $1, and the price of the McValue meals being dropped to $5. The fast food chain says Canadians are facing some challenges, adding the freeze is what customers are looking for. In recent months, Tim Hortons, Wendy's, and Burger King have all introduced meal deals or small combos. Delta shares fell today after the airline beat earnings expectations, but issued a full-year revenue guidance that fell short of expectations. The company is also hesitating to commit to record earnings with rising geopolitical instability. Limited foreign travel to the U.S. from Canada and China was of concern. Delta recently made the decision to order 30 Boeing 787 Dreamliner jets in its first-ever purchase of that model. CI Management's acquiring Invesco's Canadian fund business, a combined total assets of approximately $26 billion. Now, under this agreement, CI will manage 100 mutual funds and exchange-traded funds currently offered by Invesco Canada. As a result of the transaction, CI's assets under management will increase to about $170 billion. The transaction expected to close in the second quarter of the year. U.S. earnings season kicked off today with fourth quarter results from J.P. Morgan. The bank had a decent EPS beat, but investment banking was disappointing. We were joined today by Stephen Bicker, Director of Financial Services Research at Argus Research.
The investment banking results were a bit weaker than expected. There's been this multi-quarter narrative about how constructive the capital markets environment has been. So this could have been some timing. You have to close deals in the quarter in order to book those revenues, and some of that could get extended into 2026. We're still looking for this extended upturn, and the constructive commentary they did mention on the conference call this morning. The backlog is growing. You think you've got lower interest rates, you've got improving CEO confidence and boardroom confidence. You've got this pent-up backlog after kind of a weak 3-year period. You've got more relaxed regulatory framework, and all that really bodes well for the both the IPO and the M&A activity for banks with large capital markets operations.
J.P. Morgan, though, rolling up its sleeves for a fight, it seems, over any attempt to cap interest rates on credit cards. The CFO saying we'd have to significantly change our card businesses and that everything is on the table in pushing back.
Well, it sure is. Yeah, I think we'll see a very strong response by the industry here, as well as the industry advocates in this space. It's very difficult to when you kind of mess with this with a bank's ability to price risk and only just kind of this one part of the equation, the interest rate. Bad things tend to happen. Whether it's the removal of credit availability, which is very much a disservice to consumers. You put extra risk in the system from not being able to cover credit losses adequately. We saw this in the financial crisis, where in the case of home lending in that era, where you make loans too easy to get and fuel speculation. You get bubbles and then a collapse in the very asset you're trying to help. So it's important to be careful here, I think, and take some time. And I don't think that is kind of inherent in the president's 10-day implementation period here. It's guardrails are very important, but it can be over-regulation can be just as detrimental as under-regulation or poor regulation.
It's interesting, the stock up more than 30% in the past year. According to Bloomberg, though, there are 19 buys among analysts, but 12 holds and 3 sells. So it sounds like Wall Street not convinced that there's going to be big gains in the near term anyway for the shares.
Well, as much as the narrative on profit growth, I think, is intact. If you ask all or most of those analysts, they would say, look, it's going to likely be a good year for profits for J.P. Morgan. So the question is about valuation. Has that 30% gain we've seen, is that kind of take into account the expectation of continued improvement in 2026? And I would say, this is kind of a unique time for banks, particularly the large and the global banks, where this a bit of a re-rating is going on. Not only do they have this long runway, we think, of improvement in capital markets, and that is a big wild card in terms of revenues and profits for banks. So that extended upturn could lead to valuation improvement. We also have this kind of generational change in regulatory, right? Ever since the financial crisis, it's been nothing but more and greater regulation, more compliance costs, and all this to satisfy regulators. And we think we're in a period now where that is at a minimum going to stay steady and maybe even more likely soften a bit in terms of capital requirements. So that helps free up capital for lending and other uses, for buybacks, for dividends, and so forth. So I think we're going to have, if you think about the banking industry and kind of how it's evolved, and these stocks are not terribly expensive either, kind of 13 to 15 times are the 26 consensus estimates. So I think there is some more room. I don't expect 30% gains out of these large bank stocks, but and they have outperformed the market the last 2 years running. So this will be a third year. That's a little difficult. But again, I think the momentum is behind the profit story, and the re-rating does help those multiples.
I suppose one thing that could inflate their earnings would be a whole pile of initial public offerings and takeovers in the tech space fueled by AI.
Well, definitely. Certainly if you think about M&A and global announced M&A deal value is up 40% in 2025. So again, a lot of pent-up demand there. It's this boardroom confidence, the competitive pressures to cut costs, the more favorable regulatory environment I mentioned. All of that can add to deal demand. And there's been a lot of these mega deals, especially, definitely in vogue now with. You think about scale across technology or the financial sector, industrials. Falling interest rates obviously is helping on the financing front. We've got very banks that are willing and able to lend. We've got a market that's willing and able to accept new equity, new debt issuance. We had $95 billion of investment grade debt issuance in the first week of January. So that's the highest level since the pandemic. Credit spreads are around 15-year lows. So that's very good for debt issuance. And so the market is, I think, is waiting for that, and is helpful in terms of making financing available. So all of that is really helping the M&A environment.
Stephen Biggar, Director of Financial Services Research at Argus Research. Delta shares fell today after the airline issued a tepid forecast. More on what is weighing on travel when we come back. We've been watching shares of Delta today after the airline company made a profit growth forecast that fell short of Wall Street estimates. For more, we were joined by Stephen Trent, independent aviation specialist.
With the guidance for 2026, they were in the lower end, let's say, to some degree, calling out economic uncertainty. But I would say, from a broader industry perspective, the lower end of the totem pole, U.S. consumer would be the place to watch. How does main cabin develop? Do we see some of the M&A out there coming through to fruition? If we happen to get this 10% cap on credit card interest rates, that's something that ostensibly would be worse for the lower end consumer versus wealthier consumers at Delta, American, or United Airlines. So maybe that would, from an industry perspective, be the place to watch.
Okay, for Delta, with the main cabins, how important is it that they are full as opposed to first and business?
Yeah, so Delta derives the majority of its revenue from outside the main cabin. So far more important what we're seeing on international first business class and the loyalty and co-branded card. Main cabin wise, can these businesses, let's say in basic economy, withstand relatively low yields? Absolutely they can, because it's a very small number of seats. So I don't think it's particularly a big problem for the big three. I'd actually still be worrying more about the lower end of the market on the ultra low cost carrier side of the fence.
And who are some of those that people should be paying attention to, do you think?
Well, definitely in that segment, Spirit Airlines front and center. They've certainly had challenges with respect to the latest Chapter 11 filing. Maybe they don't merge. But if you look at not just Spirit, the ULCCs generally, everyone is trying to be more like Delta, American, United, talking business class cabins. Some carriers out there trying to launch more international. They're trying to launch premium lounges at airports. So there is, I would say, clearly a move away from that model because it's not making money.
Could we see some, you're talking about mergers and acquisitions, could we see some of maybe the big three picking up one of the lower cost ones?
So that in itself might be a little bit challenging for the big three, not only because of business model differences, but also because of their pretty large scale as it is in the domestic market. But certainly, you've seen the on again, off again. Frontier looks like it's out there courting Spirit Airlines. There was some news, of course, coming from Allegiant and Sun Country, for example. You could even carry this more broadly in North America, south of the border. Volaris and Viva Aerobus in Mexico may be doing the same. So I think if there's M&A in the space, it's going to be outside of the network airlines.
Would Canada play in that at all? A company like WestJet, something like that?
Never say never. I think once you start to get into potential international cross-border type transactions, it gets a bit more complex. But I would say it's certainly the one very dominant network carrier in Canada. All else equal, would have at least some of the same challenges in going after a big acquisition on its own, for example.
Okay, and then the other one you mentioned about the credit cards with President Trump saying he wants to put that 10% cap on for the year. It likely won't go through, but what would happen if it did?
Yeah, great question. So I think that is a huge if. I think there seem to be a lot of steps that would have to occur for that thing to go through here. But let's say that it did. All else equal, I'm kind of putting on my banking hat there, but I think there's a possibility that lower end consumers would have trouble getting credit. Maybe some of these people would have to go to riskier areas of the market to try and obtain credit, potentially at higher rates, more onerous requirements on loans and that sort of thing. All else equal, wealthier consumers may or may not be as much as an issue, might not be much of an issue. And if you look at the U.S. big three, Delta, American, United Airlines, their co-branded cardholders are in that wealthier segment that probably are going to be, relatively insulated from this, assuming that it even happens, which I would say is a huge if at this very, very early stage.
And just bringing it back to Delta, one of the things mentioned by the CEO, I believe it was the CEO that made, specifically on some of the travelers, Canada and China were having an impact on the bottom line. Just how much of an effect, or have you seen how much of an effect they are having on that?
Yeah, look, I think that is an important topic when we move forward. If you look at the U.S. Big Three international flow, 80 some odd percent of it is U.S. originating, but there's still a meaningful portion of that flow that comes from outside the United States. So if one does look at what kind of risk we have in, let's say, the possibility that inbound international travel gets worse, that's absolutely something to watch. And of the big three, United Airlines has the highest international exposure, Delta in the middle, American Airlines of the trio has the lowest level of international. Absolutely, it's something to watch. And I would say, certainly the Chinese traffic flow may be a little less concerning just because we're still way off pre-pandemic levels and probably not a huge expectation for that to come back to pre-pandemic levels. The Canadian flow is a different story.
Stephen Trent, independent aviation specialist. Coming up next, a Toronto-based startup successfully launched 10 data relay satellites on the weekend. We talk about what it means for Canada's space capacity in a moment. Toronto-based startup Kepler Communications launched 10 optical data relay satellites on the weekend. The company's network enables data processing and analyzing directly in space. We were joined by Meena Mitri, CEO of Kepler Communications, to talk about what the aim of the satellite really is.
They'll be able to route data between themselves, between third-party assets in real time. And so the big difference that we're bringing to the world right now is the ability for this data to come back in real time. So it can help everything from first responders get access to wildfire detection information so they can effectively manage and deploy their resources, all the way through to defense organizations who want to do in-orbit processing so they can better understand, what is their situational awareness so they could do intelligence, surveillance, and reconnaissance all around the world.
And when you talk about real, is it literally instantaneous, the information?
That's right, yeah. So the norm for most space missions today, it might take them 30 minutes to 3 hours to get information back down to Earth, where when we bring up this network and it's fully operational, data will be flowing at 700 milliseconds. So it's as instantaneous as information gets exchanged on the traditional internet we have here on Earth.
And how is that possible? Is this technology you've developed?
So this is the advent or a confluence of few technologies that have come into existence and stuff that we've developed in-house. So the core enabler to the work that we're doing today are laser links that we're using to beam light between different satellites within our network and to third-party satellites and eventually back down to the ground. So building off the momentum we had in 2023, where we tested these laser links that are able to communicate with an aircraft, with another spacecraft, or with the ground, we're able to move this data in through space, much like a mesh network here on Earth, so that it eventually finds its way back down to Earth in real time. That's the real core enabler. And apart from that, it's also the great satellite capability and satellite building capability we've developed here in Toronto in our factory.
And you literally are these lasers, the information is in the laser itself, in the beam?
Yeah, yeah, you got it. So the laser beam is very much like fiber optic cable here on Earth, but in space, because we've got the void of space and it's a deep, dark vacuum, we can shine lasers between our satellites without needing a physical cable to connect them between one another. It's a really hard problem, though, to solve because we're pointing a laser pointer to an object that's roughly the size of a quarter, sitting 6,500 kilometers away, and we have to hold that laser pointer steady. So that's the core intellectual property that we've developed here inside the business, is how do you build, deploy, and operate a satellite that can hold that laser pointer or that laser marker really, really still.
And now you've got 10 up in space. Are you making money off these now?
Yeah, we are. So we are live deploying applications with a few of our marquee customers. Yesterday, we announced one of our key customers, a company out of Germany called Aurora Tech, where we are supporting them to do live wildfire detection and wildfire monitoring. That has a ton of applications, especially with the big wildfire season we experienced last year here in Canada. And it services national and international governments with the same. We also have a few orbital data center customers. So on board of our satellites are a wide series of GPUs and CPUs that are used for doing on-orbit processing that allows, financial institutions and other government-type customers to be able to process and route their data in orbit for using of that orbital data center. So we have a number of different use cases and applications, and we'll be continuing to announce them over the coming months.
Now, are these the data centers that Elon Musk has talked about, the space data centers? I mean, they're not very big, these satellites, but how much information can you store up there?
Yeah, so these satellites are roughly 300 kilograms in mass, or 600 pounds. Those are pretty beefy spacecraft when you think about them. They're also operating in a sun-synchronous orbit that is dawn-dusk. So when you hear a lot of the mainstream media communication today, the dawn-dusk orbit is really an orbit that has a ton of sunlight in it, which allows us to generate an enormous amount of power, but also keep our satellites a little bit smaller relative to what an end data center might look like. The key advantage here is these data centers are all networked to one another, so we can distribute compute resources between all of our different satellites when a workload comes in. So if somebody needs something to be operated in space, we'll decide which of the satellites will run that workload. And we have many, many different GPUs across all these satellites that are real-time connected to allow us to run those workloads.
Okay, and now you raised $200 million, I believe was the number, or close to that. Where are you looking for another? Are you looking for more funds, or are you thinking of an IPO?
Yeah, we've raised over $300 million US in capital to date, and we have had the benefit of really supportive investors throughout this time period. We'll be continuing to raise additional capital through the coming year, just on the basis of expanding our network, adding additional data sources, and really building out what we think is the first of its kind of a cloud-like environment where new space missions can be developed, deployed, and run instantaneously.
And do you see yourself going public?
In the long-term future, I think we see a lot of private companies staying private more so these days, with ready access to private investors, the ability for them to really focus on and concentrate on their core mission and their core differentiator without the public markets really challenging the work that they're doing. So, we'll keep the company private for as long as we can.
And just one last question: with government talking about defense and spending increasing, where do you see yourself fitting in with that?
Yeah, so defense really, really cares about the ability for them to get access to real-time information. So if you think about any conflict that they're in, the latency that information has dramatic impacts on their operations. So some of the upcoming applications we'll be talking about include real-time access to intelligence, surveillance, and reconnaissance data that allows these government organizations to get their same data sets that they're used to using in operations, but delivered to them in real time so that they can better improve the totality of their operations. The uptick in defense spending has been a huge tailwind for us, especially in Canada and in the international markets that are looking for real-time access to data.
And one last thing, is there any other companies that are offering real-time? Do you have any competition right now?
In the real-time data marketplace, there's not a whole lot of companies that are offering their data sets in real time. The majority of companies today focus on the traditional way of getting their data back, which is downlinking it to a ground site, which might take anywhere from 30 minutes to 3 hours. So we see ourselves pretty differentiated out there in the market.
Mina Mitri, CEO of Kepler Communications. An update to the ongoing bidding war for Warner Brothers. Bloomberg reporting Netflix is reworking its offer, one that could include an all-cash deal. The changes are designed to expedite a sale that is expected to face government scrutiny and has been drawn out, of course, by demands from Paramount Skydance, who also wants Warner Brothers. Netflix shares have lost about a quarter of their value since the start of the bidding war. Know Your Options is back tomorrow, 3 p.m. Eastern. Have all of your options trading questions answered by Chris Tom of Moat Financial. You can send your questions in to knowyouroptions@bnnbloomberg.ca. Thanks for joining us today for The Close. We'll see you tomorrow.